Hi, I am Jorge. I'm running The Officials, a new publication covering the physicals and derivatives markets. You want to know about what is really happening? Read it. You want to hear about the real stuff? Come and watch. I am The Official. Today, we have the first edition of this program, and we are going to discuss various important market events that took place this week, starting most likely with the Trump issue. But there are also some price distortions in the US that we would like to address. I am joined in this effort by Will Conliffe, Harry T., and Vincent Wu, otherwise known as Dr. Wu. We will start with the most obvious event of the last week, which is the attempt on Mr. Trump's life, which shook us over the weekend. But by reading all the newspapers and various commentators in the US, where it matters, it almost assures that he will win the election. So the Donald is back in by all counts. And I wanted to invite Harry to just give me a little high level of what you think the impact will be on oil markets over the long term as Trump and Vance, his VP, are both essentially don't want to have too much worrying going on and focus more on domestic matters. So what are your thoughts?
I think, Jorge, it's right to point out the longer term because even if President Trump's to become elected the 47th president of the United States have certainly increased as a result of the recent terrible events, whatever President Trump can do in his second mandate is take executive action to deregulate, authorize more drilling, authorize pipeline access, lower taxes, etc. And all these things will obviously have to filter through before we see a resulting increase in oil production as a result of these decisions. So he, if he were to be reelected, would take office in January. Let's say over the next couple of months, he speeds through his agenda. Then it would be something for the second half of 2025 in terms of how U.S. oil supply may or may not benefit from what President Trump decides to do. So at the end of the day, is it going to be drill, baby, drill as a result of a second presidency of Donald Trump? It's possible, but timing is crucial. As you said, there's no immediate impact. We're going to have to be looking for the second half of next year.
And it makes a lot of sense because you can authorize pipelines, drilling, new licenses, all those issues, and that takes time. Another issue I was thinking is whether there would be a rapprochement with Russia on the Ukraine, and that could have more immediate effects because if some of the sanctions get taken down, for instance, ships would not go in a big merry-go-round around the planet, but go on more of a direct route. And I wanted to see if Dr. Wu has any comments on that.
Yeah, sure. So there will be a lot of speculation about a potential the potential incoming Trump administration's foreign policy in regards to Russia and Ukraine. However, should sanctions on should Trump go for peace negotiations, we have to also see how that plays out with respect to his foreign policy in the Middle East as well as East Asia, because even if let's say sanctions are eased, flows are rerouted, his stance on Israel, on Iran, that could lead to further geopolitical risk in the Middle East, but also potentially escalating the trade war with China and how that might affect tariffs, imports, and etc.
So here comes the question altogether. So if you can have potentially more production, shorter shipping routes, trade war with China, which slows down the world, what is the impact on price, Dr. Will?
Well, we'd think that would be a bearish signal. But prices seem to be kind of stuck in this $85 range, almost kind of rubber banding. So yeah, we're getting very kind of mixed fundamental signals.
Yeah, in the short term, it seems very stuck at 85. But Harry, what?
Yeah, I think we, we have to make sure that we get our timeline right. And, a lifting of sanctions on Russia or even on the shipping of crude does not necessarily mean that Europe is going to buy back Russian crude in the amount that it did previously. So at the end of the day, the big rerouting of trade with the Russian crude heading mostly to India and then, of course, China, that may simply pursue, right? So at the end of the day, I think we have to be a little bit careful about what Trump can achieve with Russia, what Trump can achieve in the Middle East. Certainly his friendship with Putin, or friendship, I'm not sure that's the right word. Let's say that their closeness may help. But at the end of the day, when we look towards next year, and assuming that Trump performs some kind of geopolitical concoction that allows for all of this to happen, we're not looking at strong growth in demand in 2025 in terms of the general economic outlook, in terms of how much catch up there's left over, if any, from the COVID era in terms of reinstating demand. And against that, we have supply. So Russia may be able to supply more areas. U.S. crude production will certainly grow more under a Trump administration. Newcomers like Guyana are certainly ramping up fast. So at the end of the day, we're going to have to settle to some kind of fair value. And perhaps, as Will was saying, that fair value that is both satisfactory to consumers and producers, maybe $85, maybe $80, it's always hard to say. But that would also require, on behalf of OPEC, a continuation of withholding production from the market.
Discipline.
So fiscally, they're losing out. You saw the IMF forecast for Saudi Arabia and the downgrade. How much more are they going to forego revenue by withholding production? And if they add back oil onto the market next year, in the circumstances that we discussed, maybe that above 80 figure is going to be looking more like a 75 than an 85. You see what I'm saying?
And Will pointed out in today's report of the officials, which all of you should subscribe to, that Saudi Arabia has issued and successfully completed a tranche of revenue raising by issuing US denominated bonds. Do you want to add a little bit of color to that?
Yeah, so they've issued 3 tranches of bonds, about $6 billion worth of debt financing. And this kind of really, it not only speaks to kind of that they want to expand and they want to invest, but also
They need the money, don't forget that.
but also
Yeah.
but also it's kind of it's a reassurance that the greenback is sort of here to stay in a way. Like a lot of people have been challenging proponents of de-dollarization, and I think a lot of people want that, including Russia and China and India. But this is kind of really a kind of move back towards the dollar as the strongest denomination. So that was interesting.
Yeah, we have a lot of discussions here about the dollar and also the gold, which seems to have hit recently the highest in maybe not in a long ever, but in a long time at $2,500.
60s or 70s,
Yeah.
maybe.
And it seems very strong. And we were discussing internally about the UBS report with where a lot of the central banks are not comfortable holding foreign denominated reserves, and they like a little bit more the gold because it's unseizable. What are your thoughts on that? I get a sense altogether here that we like the dollar, we want the dollar to remain strong, but is it?
I suppose that, anytime a central bank reviews its portfolio of foreign currency, of which gold is included, we'll actually be looking at seeing the motivation, right? And that motivation, when it comes from areas such as China or Russia, is obviously geopolitically related. In the context of trade wars that we talked about, in the context of confrontation around actual wars, the ability to seize or deny the use of currency by the U.S., deny the use of its currency, prompts obviously certain actors to want to be able to disengage from that dependency. And thus, diversify into gold. So China, it could be India, Russia, but we're also seeing increased central bank demand from gold in such areas as Africa and even Latam.
Yeah, this will have, of course, over the long term, an impact in the use of the dollar and the petrodollar. One of the shoes that we are waiting to drop is whether China and Saudi Arabia eventually settle their accounts in yuan rather than in USD. I don't know if, let's pick on Dr. Wu. Any thoughts on that?
I think oftentimes it's we need to have a look. We need to go beyond just the rhetoric to see what is actually happening. Of course, there will be a lot of intention from non-Western countries like the BRICS bloc to essentially de-risk from the dollar, perhaps essentially trying to de-risk from sanctions. However, the dollar seems it is the incumbent dominant currency in the world, and there will be attempts to de-dollarize will be faced with a lot of inertia or resistance, because by settling oil trade in yuan or not in dollars implies a currency risk. So currently global oil is traded all in dollars, but it will also depend on how stable the yuan is with respect to the dollar, and as well as liquidity, which has been cited to be an issue, especially with capital inflows and outflows. If those issues get sorted over time, when investors have more confidence in the yuan, then perhaps we can see get the dice rolling, get the ball rolling.
I'd say what's actually quite important is in terms of de-dollarization, one has to realize that it's not just about the means of payment for your barrel of crude. That tie between Saudi Arabia and the United States through dollar-denominated oil is extremely strong. If Saudi were to break away from that, that would certainly cause a massive geopolitical rift. The other thing, of course, is while people talk about settling in different currencies, you can already do that, of course. Commodities still traded in dollars, you go through a bank, fix the exchange rate, settle in the currency that you want. But let's not forget that China is also pretty heavy-handed when it comes to regulating its financial markets. We've seen it in its stock markets. We see how it manages the offshore yuan. So there's also currency risk associated with a system that heavily controls its money and how that money is traded abroad. So you have two sets of risk.
So if I may interrupt, it's like going from the pan to the fire then, is what you're trying to more or less say, right?
Yes, I'm saying it's not a one-sided risk. Dollarization, of course, and dependency on the dollar and being able to trade in dollars is one thing. And of course, as you know, Jorge, the US could intervene in terms of international means of payment, whether it's SWIFT, whether actually allowing other countries to clear dollars with its banks in terms of transactions. But think about China. Think about the number of times that they have intervened in financial markets, how tightly they manage their exchange rate. That in itself, in terms of interventionist risk or sovereign risk, if you will, is also an element. So it will become interesting to see if countries where we see rapprochement, as I say in French, between India, say, and China, where they may actually, because of bilateral trade, be able to settle some trade in rupees, some trade in yuan. And one could imagine that petroleum products could be part of that mix. Now, since neither is exporting country in crude oil, really, how crude oil gets traded in the world, I still personally think is going to remain dollar-centric for a long time.
Yeah. No, I appreciate, and we have these discussions internally very much, and we will notify you as a reader of the officials when we find any evidence that somebody is switching horse, so to speak. In the meantime, the influence of the US is, of course, disproportionate with its population. As we were discussing internally, it's 360 million people versus 8 billion in the world, but everybody's thinking about Trump, Biden, the elections, the impact. And of course, in markets, Brent is a little bit disproportionate in relation to to the rest, and we have observed unusual movements, otherwise called squeezes, in that market. And now we're observing unusual movements in the TI market, where the spread between Brent and WTI was roughly $4, and this morning went to 350. So it gained around 50 cents in a few hours, and is not something happening with Brent. It's something happening with TI because the spread, the intermonth spread, is widening. Harry, any thoughts on that? We discussed briefly in the morning.
We discussed this. I think it's quite interesting because, again, it's a move that took place really over a day. Yesterday morning, we're at minus $4. Wake up today, minus 350, then minus 360, back up again. If you look at it fundamentally speaking and trying to tie the spreads to the level of inventories at Cushing, which at the end of the day is the delivery hub for the NYMEX WTI contract, yes, we had some erosion in Cushing crude oil inventories, but really not to the magnitude that we're testing tank bottoms for that front end of the curve to steepen in the proportion that it did in the time that it did.
That's very fast.
Very fast. So obviously we don't have the information, but we could conjecture that, what is the composition of crude stocks held at Cushing? So when we look at U.S. crude, we talk about DSW, or domestic sweet grades. Is there enough at Cushing of this light sweet crude, or does someone have an insight as to the composition to say, well, actually, when you deliver into the contract, you're supposed to deliver a light sweet crude? Maybe the stocks at Cushing are tilted towards medium and heavier grades rather than sweet grades. Maybe that could be part of the explanation. Or, as we've been hearing and you've been reporting on, refinery demand, that is fed from Cushing, is growing. What are the motivations behind that? But I still think that the move in itself is so fast that fundamentals don't move that fast. And I'm thinking, weighing more, that someone is taking a view on what's going to happen next. And that could be U.S. crude exports picking up and tightening up U.S. balances.
And as per normal, you're very polite.
Of course.
Somebody's taking a view. My question is more to the rest. Is anybody squeezing TI? Because the expiration is coming up, and they're having a little bit of a go before the contract goes off the board.
I'll let my colleagues opine on whether that is the case or not. What do you think, Vincent?
Yeah, well, if history is anything to go by, we saw something similar last September, where Cushing, there was a squeeze in Cushing as inventories rapidly declined, and the front WTI spread reached surged to around $1.80 per barrel. Currently, it's gone up from like 70 to 80 cents up to $1.40. So looking historically, there's still room to go up, but at the same time, because of its super volatility, because of its surge, the mean reversion could see a rapid fall as well. So that's something that traders should be careful of. Because a lot of bearish traders will be waiting in the wings, wanting to catch the falling knife, and it's all about the timing of this trade.
Yeah.
But as we know, Cushing stocks are not at tank bottoms. So we're still left with this wide open question: who's taking a view and on what?
Yeah, and one of the things we want to do, of course, with the officials is always remain open to evidence. So if you have any views, anything to share with us, as they say in the Midnight TV sales program, our phones are open, our emails are open. Reach to us to share any idea you want, WhatsApp or whatever, and we'll continue this interaction as we go on. So thank you very much for the first edition of The Officials, and we'll see you again.